Have you ever wondered how central banks manage to keep prices stable, ensuring that your money holds its value over time? It is a complex dance of policy decisions, with different strategies vying for the spotlight in the pursuit of economic stability. Inflation targeting is a monetary policy framework where a central bank publicly announces a specific inflation rate as its primary long-run goal and then commits to achieving it. In contrast, nominal anchors are broader policy frameworks that guide monetary policy by setting a stable reference point for a nominal variable, such as the money supply, exchange rate, or the price level itself. The fundamental difference lies in their focus. Inflation targeting zeroes in on a future inflation rate, while nominal anchors often fix a past or present nominal value. The core mechanism behind inflation targeting is its forward-looking nature. Central banks operating under an inflation targeting framework forecast future inflation and adjust interest rates preemptively to bring expected inflation in line with their target. This approach allows for significant flexibility, as the central bank can respond to various economic shocks without strictly adhering to a rigid intermediate target. On the other hand, traditional nominal anchors, such as a fixed exchange rate or a specific growth rate for the money supply, are often more backward-looking or rule-based. A fixed exchange rate, for example, ties a country's currency value to another, automatically importing that country's monetary policy, while a money supply rule dictates the amount of currency in circulation. These anchors offer simplicity and can be highly credible, but they also reduce the central bank's discretion to respond to domestic economic conditions. To distinguish between them, consider how a central bank communicates its objectives and conducts its policy. If a central bank consistently emphasizes achieving a specific, publicly stated inflation rate, typically around 2%, and regularly publishes inflation forecasts, it is likely practicing inflation targeting. Conversely, if a central bank primarily talks about maintaining a fixed currency value against another major currency or strictly managing the growth of monetary aggregates, it is likely using a nominal anchor strategy. The choice often depends on a country's economic structure, its history with inflation, and the credibility of its institutions. Interestingly, many central banks have evolved towards what is sometimes called flexible inflation targeting. This approach incorporates elements of both frameworks by targeting inflation but also paying close attention to output stabilization, acknowledging that strict adherence to an inflation target at all times might cause unnecessary economic volatility. This blend represents a sophisticated adaptation, allowing central banks to maintain price stability while mitigating the severity of business cycles, a concept known as constrained discretion. Understanding the distinctions between inflation targeting and nominal anchors is key to appreciating the varied approaches central banks take to foster a stable economic environment. These frameworks, despite their differences, share the ultimate goal of preserving purchasing power and promoting sustainable economic growth by providing a clear guide for monetary policy decisions.